Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us this week. Some weeks are just more newsworthy in markets and more eventful than others, and this certainly is one of those weeks. So we really want to be here and help unpack the things that help drive it, where we at, and give you some context, etc. Really, there's two factors that we'll go into. We're going to talk about interest rate outlooks, which is one piece that really has changed over the past few weeks. And then Andrew's going to take a deep dive for you into what we think are some of the catalysts behind this market decline. So let's jump right into the interest rate outlook. So last week, the Federal Reserve had their July meeting. And importantly, during it, there was no expectation that they would cut interest rates now. But the talk and the movement all along the summer has been that they would open the door and begin to cut perhaps in September. So that is certainly the impression leaving the meeting is that that was on the table, not a guarantee, but that was all the markets need to hear to basically price in a near certainty of a cut and perhaps as much as a 0.5% of a cut. And so very quickly, the market has gone from when they will cut to whether or not they are already behind the eight ball in terms of a cutting time frame and whether they've gone soon enough and whether they can in turn then go far enough. One of the factors or the things that really feed that view are policy rules. So there's a variety of them. So just take a step back here. And so our interest rates, the Federal Reserve overnight interest rate is set by the policy members. Of course, Jerome Powell is the chairman, but there are other voting members. But ultimately, they're human beings sitting around a table and deciding where interest rates should be based on their economic outlook. There are those who, in the academic world and other professional economists, who have over time argued that it needs to be more of a rules-based approach that says when the economic data looks like this, the interest rate should be that. And of course, that's we're a long way from ever getting there, but those rules are certainly a good framework for interest rates might ought to be, and they're certainly influential into how certain of the Federal Reserve members think. And so this is a messy chart here because we've got four different rules. For those of you who studied economics, you may remember the Taylor rule. That was really one of the earliest and is still one of the most prominently discussed. There's a modified or an adjusted Taylor rule, a balanced approach rule, and then another version of that by the Federal Reserve. So all these lines are on here. The blue one shows you where the Federal Reserve rate actually is. So you can kind of drill into that. It's in the middle there of the chart from the middle part of the 2010s and into 2020s. It was really close to zero, but it began to escalate as inflation went up. And it's leveled off here around 5%. So these policy rules, not all of them, but most of them have converged and pointed towards somewhere around 4%, meaning that right now the Fed is maybe as much as 1% too high. So there's arguments on both sides of this coin. There's certainly a camp out there that thinks inflation's always at risk and could reaccelerate. The Fed does consider that, but the consensus has moved towards rates needing to come down and come down quickly. And to some, that sparks them, hey, what might be going on that we don't know about. So we don't jump too deep into that in terms of forecasting market direction, but it certainly was very influential in terms of bonds. Bonds have had a nice increase, which is a nice contrast to what we had in 2022 when we had a big sell-off, where bonds were actually the biggest driver during this minor pullback, which is what we've seen so far. Bonds have been a very big help and a reminder why diversified portfolios, that even times where bonds can be a drag, during many market environments, especially destabilizing ones like this, can be a help in the portfolio. So that is a good thing. From what we've seen over the past week is some help from that side of the portfolio. So Andrew, I will pass the ball over to you to dive into the specific stock catalysts.
All right, thank you, Adam. So as we came into the end of last week, we started seeing some increase in market volatility. Equities started to gyrate a little bit more. And then on Friday, we really started to see things accelerate quite a bit into the weekend. One axiom that often goes across Wall Street is that markets rarely bottom on a Friday. And we definitely saw that play out this weekend, while we saw some developmental things happen in Japan that really started to spook markets. We opened up the markets in the US on Monday. We really start to see volatility pick up quite a bit and equities start to continue their downward trajectory. Want to look at some of the things that helped cause this. Of course, we're always not so much concerned with the cause, but want to understand the catalysts and understand if these catalysts can typically cause an acceleration of continued decline in the markets, or if they can be more shorter term. So one of the first things I'm going to look at is volatility. The reason being we saw a massive, massive spike in volatility. Volatility is essentially often inversely correlated to the S&P 500 or the equity market. When the equity market goes down, volatility goes up, and this is just a gauge of how much movement in percentage terms that the equity market will experience over the next month. It gets into a lot of the complicated math, but essentially what we want to often refer to this as kind of the fear index. When volatility goes up, it often means there's a little bit more fear within the equity market. In 2017, I wrote a paper that won the Charles Dow Award called Forecasting a Volatility Tsunami. What it looked for is trying to predict and forecast periods of these massive spikes in volatility. And that's kind of what led up to the environment we're in today. When we start seeing markets become really, really calm, really smooth, think of it as driving on a really smooth road and you continue to accelerate your car going a little faster, a little faster. That's what we saw happen during May and June into July, where it was a very calm market and a lot of traders started to go a little bit faster than they maybe should because the market was just so calm. This ultimately opens the door for these volatile spikes to where, because so many people get so overconfident, they hit a rough patch, they hit a bump in the road, and volatility spikes higher like we saw today. And we measure that through standard deviation. We can see in the red box on the screen, it got really, really low. That just tells us that volatility was really not moving at all, kind of had gone to sleep. That proverbial road was really, really calm and smooth. And then we see that spike higher. The other part that really helped was the catalyst for this market decline is something we've been talking about all year long. And we kept referencing that it wasn't necessarily a timing tool, but helps identify a market environment. And that's looking at just how massive some of these stocks in the S&P 500 have gotten. This chart comes from Goldman Sachs and looks at the percent of the S&P 500 found in just 10 stocks. You can see just 10 stocks account for 37% of the S&P 500, higher than well above the levels that we were seeing during the dot-com boom, going back all the way to the 1980s. Just a handful of stocks really have been driving and controlling this market, kind of the tail wagging the dog. And so we've discussed in our allocation meetings and several times on these Market Carver calls, videos, that how these mega caps do, just these handful of names, if they go up, the market can go up. But if they start to wobble at all, that we can start seeing the market really start showing some downside pressure. And that's what we began to see, that some of these mega cap names began to crack, like Nvidia, Facebook, Google, Amazon. They start to go lower, and that causes a lot of discomfort for a lot of traders, and they start to increase their selling pressure. And we saw that play out beginning last week and in the start of this week. And so we recognize the kind of environment we're in. Traditionally, when we see spikes like that in the volatility index, traditionally it can cause some more short-term gyrations, but typically long and intermediate term actually can provide opportunities for the market to go higher as that fear gets expressed and gets to be resolved, and the market's able to get back into its regular trend once we start looking for confirmation that buyers have started to come back. Looking at the percent of the market cap, this allows us to really understand what's driving the market. We recognize that a handful of stocks we really need to be focused on in understanding the supply and demand pressures of those names and really focus on how they're acting to understand the health of what's really kind of that tail wagging the dog. And so it allows us to really focus in on what's moving the broad market and also look for maybe opportunities that are being ignored in other parts of the market, maybe other sectors or different factors that we can look for profit opportunities to express within the models and portfolios and take advantage of some of this fear that's entered the market as we start looking intermediate and longer term. So we're always looking for opportunities and potential when we start seeing things get a little volatile, doing the best we can to manage risk, but then also looking for some opportunity and reward as well. So hopefully that provides a little bit of insight without getting too far into the weeds and the noise of what's going on in the market in the short term, of what's provided and what's caused some of this recent market volatility to enter domestic as well as international equities here recently.
All right. Thank you, Andrew. And thank you to all of you here for giving us a few minutes of your time in this important week. And just a reminder here that we are always here going through markets day by day, minute by minute. And if you have any questions, anything that we can help with, don't hesitate to give us a call. And we send out these videos to kind of give you help of some of the bigger points that we're looking at. You're certainly welcome to join our Investment Monday allocation meeting. That's a more detailed version of the things that we share here with you, but you're certainly welcome to join along. But in any event, know that we've got the wheel or are behind here, and glad that we have diversified strategies behind everything that we do. So thank you so much. Have a great weekend.